Good morning and welcome to the Killik & Co market update. We've had a relatively quiet week of corporate results, but it's been a busy week in terms of economic data. The UK economy returned to growth in April following the contraction in March. The expansion was driven by increased retail spending and growth in the services sector. The outlook for the UK economy has improved in recent months, with the Bank of England and the IMF no longer anticipating recession this year. Data also showed that the UK unemployment rate continued to fall in the first quarter of the year, and wages accelerated at the fastest pace in 2 years. Sterling strengthened over the course of the week. The Bank of England have warned that the big pay rises are contributing to the UK's stubbornly high level of inflation. The bank's Monetary Policy Committee will convene next week and are expected to hike interest rates for the 13th time since 2021. US inflation data was released earlier in the week and showed continued moderation in price rises. Inflation increased by 4% in the 12 months to May. This is the lowest rate in 2 years and is also the 11th consecutive month of price decreases. There have been a number of central bank rate decisions this week, and the Federal Reserve left interest rates unchanged after hiking rates 10 times in the past year and a half. However, the Fed did signal that the additional rate hikes are likely this year and that we're unlikely to see any interest rate cuts in the foreseeable future. Markets widely anticipated a pause in interest rates, and the S&P 500 reached its highest level in over a year. A major theme for markets looking ahead is whether the Federal Reserve can tame inflation without inducing a recession. Inflation has been moderating whilst the US labour market has remained very resilient. This has led some economists to forecast that the probability of recession has receded. Other economists present a more bearish view, on the basis that we're yet to see the impacts of previous rate hikes permeating through the economy due to the lagged impact of monetary policy. Over the past 40 years, there's typically been a lag of over a year between the final rate hike and the onset of a recession. Equity markets have been pricing an increasingly optimistic outlook as the economy and corporate earnings have fared much better than anticipated, whereas bond markets have been pricing in a recession for some time. This chart reflects the probability of a recession in the future. By measuring the spread between the returns of long and short-dated bonds, it implies that a contraction is unlikely to occur this year, but is likely next year. It's been a quiet week for our research coverage, although Tesco provided an encouraging trading update this morning. The company reported like-for-like sales growth of 9% in the first quarter of the year. Encouragingly, Tesco also reported that some cost pressures are starting to ease. Consumer food prices have remained stubbornly high, despite falling wholesale costs over the past year. There was speculation that the government planned to encourage supermarkets to introduce voluntary price caps on basic foods to help tackle the rising cost of living, but the government has clarified that they do not intend to introduce these measures. Moving to the earnings calendar, it's another quiet week next week, but we will hear from Accenture next Thursday. That's all from us this week. If you have any questions or feedback on today's update, please do get in touch with us by emailing info@killik.com. Have a great weekend and we'll see you soon.